basis point cut, nothing has happened. But nobody is bothered about it, actually. So basically, the big risk is when the macro bites back, actually. Macro is just like animal which sits in your garden, and suddenly at some point in time, it can attack you. That is why the macro risk is very much there. But right now, the momentum is in your favor, parabolic stock market, and then Goldilocks period, actually. So right now, I go, okay, I understand actually growth is going to be strong. Okay, growth is going to be reasonably strong, 3% global growth. That's very good for my emerging markets, neither very strong nor very bad. So naturally, it is very good, actually, it's including India. So whenever you think of a growth, actually, basically people talk about only growth as one side of the equation. The another side of the equation is macro stability. Growth with macro stability naturally gives you a strong currency and relatively benign interest rates. So, and then possibly the capital flows whenever there is a capital importing country, and then Goldilocks period. That is what a US is having, Southern Europe is having, and possibly India is also having. Macro stability. How I define the macro stability? That's a basic idea. Actually, these are all some of the things actually, basically, it's back of the mind. At every point of time, when you think of something, actually, you just ask this question, whether the country in which I am investing, there is a price stability, real stability, that is economic activity and employment. It is produced, loss produces cyclical volatility. Yes. And then external stability. So basically, if these three dimensions of stability is there, then actually macroeconomic stability is there. So growth alone will not serve the picture. You have to have macroeconomic stability. That is where actually India possibly tilts the scale and in favor of India actually. So basically, GDP growth is, boss, I am growing at 7%, but I don't have macro stability. Nobody cares about it. I am growing at 5%, but I am having macro stability, all the three stabilities that I have, then naturally people will flock to you. That's the basic idea. So another one interesting point of this cycle is the manufacturing versus services. Who are actually basically normally what we normally actually basically in the last 30 years, what normally people think actually was if the manufacturing does well, services will do well. That's a basic idea actually. We are all sitting with that assumption. When the manufacturing does well, the services will do well. Unfortunately, manufacturing makes up around 16% of the global GDP from 25% in 1970. Right now, actually, possibly manufacturing to GDP, China is at 27%, South Korea is 25.5%, Japan is at 20%, and Germany is at 19%. You just see these economies which are embedded with the manufacturing capacities, they are all struggling. Actually, manufacturing is only 11% of the US economy. So, whereas the economies which do not depend mainly on manufacturing, they have been doing well. That's a peculiar situation as far as this business cycle is concerned. That is why you just see manufacturing PMI continues to be in contraction, whereas the services PMI is above expansion. And then composite PMI somehow it has been pulled back above 50, and possibly it is oscillating at about 50. So there is a fragility in manufacturing that you have to accept. Why is it basically now the post-COVID, the developments actually possibly it has given rise to a sharp rise in services economy, actually, which has done well in the case of India, actually, possibly. Because of the services exports, actually, jump in services exports, we are able to finance the merchandise trade deficit, actually. That is what you are seeing. Otherwise, actually, it would have been a big struggle to continue to finance $20 to $25 billion of trade deficit with a meek growth in services exports. Services, why it has been growing actually. So services, whenever you think of services, you have to divide that into two, actually market services and non-market services. The non-market services are actually basically the growth tends to be relatively stable and non-cyclical. And we are all watching what is called leisure economy, actually. Of course, I am telling you, leisure economy, experience economy, actually, that is growing big time, actually. Of course, we all can easily associate. leisure economy and experience economy. What does it mean actually? That is where actually possibly why Southern Europe is doing well, basically because tourism does well. Otherwise, Southern Europe actually basically it used to what not too long ago, Southern Europe used to be a big headache for the Germany and France of the world. Unfortunately, now Germany and France are pulling the Europe down, whereas Southern Europe is holding the Europe high, basically because of the tourism. I think nothing more than that. Service and leisure economy and experience economy. Now, actually, basically, now experience economy is thriving, actually. You have to accept it. And possibly, I think this is the biggest dynamic shift that is happening in the world, actually, where actually right now, actually, increased spending on experiences by 65% between 2019 and 2024. This is actually staggering statistics. That is 65% increase in spending on experiences. Experiences in the sense, naturally, you go to a place and take a picture and then maybe the social media. That has had a big, big impact. That is why actually the live events, that makes a big, big splash. Live event. Actually, we would not have bothered about these live events, not to maybe even a year back. And then we would not have bothered about the tourism and services economy and all that stuff, maybe 2, 3 years back. Right now, actually, manufacturing doesn't do well. This leisure economy and experience economy, these things do well. So that is why your growth is holding up. Now, what is that actually happening in the EM space, actually, just to understand EM space? EM space, actually, basically, one biggest shift that is happening, G7 countries were contributing to the extent of 70% of the world GDP in 1980s. Right now, it has come down to 50%. Maybe in the next 10 years,
मैं
possibly
वैसे
it could be
मोस्टली
40%.
मंडी जो होएगा अभी विशाल सर ने
So, as far as emerging markets are concerned, whenever you look at the emerging markets, the guys who tend to run current account surpluses, the guys who tend to run current account deficits. This is the grouping. Because don't put all the emerging markets in one space, group them into two, current account surpluses and current account deficit. The guys who run current account surpluses, normally they are sensitive to global growth. And then normally the guys who run the current account deficit, they are sensitive to the global financial liquidity. What is the biggest problem right now? Boss, whether there will be a meltdown like 2008, whether there will be a global financial crisis. The biggest differentiation between 2008 and today is the global financial liquidity. So long as global financial liquidity is very strong, as is the case now, naturally the countries that run current account deficits, they are not going to have big problem as such. That is Brazil, Mexico, South Africa, India. They are not going to have big problem. Actually, as long as the global growth doesn't go up or suffer dramatically, the China, Korea, Taiwan, and all the guys, actually, they are going to be under pressure, actually. So basically, there are two groupings. One is the current account deficit and current account surplus. That is how you should approach EM. So what central banks are doing, actually, basically at the end of it, actually, we talked about the growth, we talked about the EM, DM, and then we talked about services economy, manufacturing economy, and then how the experience economy is helping the growth. Now, actually, the central banks, how they are trying to protect the tail events, actually. By actually, they are trying to avoid a spike in unemployment. The only thing is these guys have put a lot of money in the table. That is why the global financial liquidity is still high. You are hiking the rates. Yes, fair enough. At the same time, you are putting a fiscal impulse. At the same time, the global central banks, they are putting money on the table. So basically, there is no problem. The cost of the money is high. Well, okay, fair enough. At the end of it, the availability of money is very high there. That is why, even with despite Fed going from 0 to 5.5%, there was no big earthquake that happened, basically because the fiscal impulse from US government was there, and across the world, everybody was putting money on the table because nearly 100% of the GDP is government financing. And then the financial conditions are loose. That is why actually, even when you raise the rates to the extent of 550 basis points, otherwise normally If you remember, actually 2016 and all, even a 25 basis point rise in Fed rate, or 2013 Bernanke talking about taper tantrum, the entire world shook. Now, actually, basically, it just went through very, very seamlessly, basically, because fiscal impulse was very great. And then you had the money available to everybody, actually. Now, they are almost like Fed cut cycles. Now, actually, we'll come to this point, actually. Much depends on why, and then why they cut the rates rather than the 50 basis point cut. Actually, basically, this is a hangover. Right now, it's almost a month, actually. September 18, it happened. Today, we are sitting in October 18, but still the hangover is continuing. Basically, whenever they cut the rates, actually, you just ask the question, why they are cutting, actually. Basically, if it is going to be on account of a recession, actually, you are going to be worried. If it is an expansion and these guys are cutting, actually, basically, okay, fair enough. They are putting money on the table and then low-cost money is coming. So, to that extent, it doesn't make any needle swing, actually. That's a good point. So, job data, actually, everybody is talking about the jobs data. Actually, we will talk about it, the global unemployment trend and all. It is not a big game changer as such. Actually, I will explain it later. The central view is that US is not going to be in a recession anytime soon. Actually, today morning also I wrote, basically the kind of data that is coming, actually, it is an expansion that is continuing in US, actually. At no point of time there is going to be a US recession of sorts. That is for sure. So Fed might prefer to pause. Actually, everybody is thinking of everybody is thinking of 25 basis point cut or a 50 basis point cut. My take is actually basically September 50 basis point was a surprise to me. Basically, I was all along saying right from 2023 December, when the market was expecting 7 cuts, I was expecting no cut during the entire 2024. But September cut was a shocker to me, actually. Maybe actually, basically, maybe because of the elections and whatnot, actually. But of course, when there is an expansion and your equity markets are at all-time highs, and then you are going to cut the rates, and then you are just igniting fire, actually, as simple as this. That is what they have done, actually. That is why, actually, they are not going to control the inflation anymore, actually. Of course, we'll talk about it later. So my take is maybe actually November is going to be a pass. It may be actually basically, it may be ridiculous to say that basically because everybody is saying otherwise. But November is going to be a pass, possibly actually. Now coming to that inflation, actually, we'll just talk about the inflation. Goldilocks to 1970s, actually, whether this Goldilocks will go back to 1970s stagflation. That's a basic question, actually. Maybe actually, see, whenever you are approaching a problem in macro problem in the contemporary world, what you do, you go back to history and see whether such a problem has existed earlier. That is a very close parallel is 1970s. 1970s, they almost the same thing. 1975, they thought they had won the inflation battle. And then afterwards, actually, inflation came back with a vengeance. So that is why I am worried. Actually, of course, nobody in the main street talks about inflation coming back. For them, actually, it is a recency bias. All you guys, actually, possibly they have spent around 7 to 10 years average in the markets, actually. For a guy who has spent 30 years, we have seen all the inflation cycles and all that stuff. Right now, actually, 1970s, the same thought process. Actually, you will be surprised to say the same thought process. Oh, boss, we have conquered inflation, kind of a mood as far as Fed is concerned. And then 1975, it came and attacked once again, and inevitable second wave of inflation happened. Actually, the way in which it is happening right now, it just mimics what happened in 1970s, actually. That is what, actually, as a technical analyst will tell you, what is happening in the future will be what happened in the past, almost actually replicating that. If you see, maybe 2020s could be 1970s of the world. And the 1970s, what all happened? There were wars and all that stuff, geopolitical conflict. Yes, this is a geopolitical conflict here also. Oil prices going up. Now nobody bothers about the oil price. Yes. Social media was not there in 1970. Now 2020, social media is there and everybody is equally informed. There is no asymmetry of information. Whatever I know, you know what I know actually. Basically, in 1970s, it was not the case. So the 19 actually basically there are very few exceptions when the Fed engineered safe landing actually. And so basically, what we can inevitably see a second wave of inflation. Actually, it will not be accepted by anybody. Actually, basically, at the end of it, what I used to say, I'm not here for popularity contest. I am telling what I am seeing actually. So basically, that is why maybe actually it is not inevitable, but maybe actually second wave of inflation is lurking around the corner. You just see why gold is going up here. Okay, fair enough. Actually, gold going up and possibly VIX is holding 20, and then that is why gold is going up. But otherwise, Bitcoin is not going up. Actually, Bitcoin and gold are almost brothers in arms, but gold is going up. So it does tell you something is there, an inevitability of second wave of inflation is going to be happening, whether it happens or not. But only thing is you got to be on guard. Maybe another 2 years or a year back, year afterwards, actually, you can see actually possibly the inflation coming back. The only thing is, because of the paucity of time, I am not able to talk. Actually, this services inflation, this is very dangerous actually. Services inflation, services inflation, whenever it happens, you just cannot control it actually. Services inflation, the sense, rent inflation, wage inflation, all these things actually, basically, whenever it happens, it feeds into the other parts of the inflation. So to that extent, actually, possibly we are going to see inflation for sure, actually. Whether it is going to be some sort of a big wave, 10% inflation, I may not be sure. But only thing is volatility in inflation is going to stay. You just see the kind of volatility that has been there in this market over the last 50 years, actually. Then naturally you are seeing that we are seeing a paradigm shift in the inflation that we are used to having between 2010 to 2020, actually. Maybe stable inflation. It is not going to be the case anymore. The inflation is going to swing high as well as go down, actually. The volatility is going to be there in inflation. So looser financial conditions, I was talking, actually, of course, I will basically, if academically inclined, this is actually Chicago Fed National Financial Condition Index, actually. It is basically looser than average. The 101 is the looser than average as of last week, as of 4th October. This number tells you the financial conditions are very, very loose right now. That is why actually markets are going higher, gold is going higher. So, yes, rates have been raised, but I have put money on your pockets. What do you do? Naturally, you spend. So, of course, we talked about services versus manufacturing economy. The services inflation and the rental inflation, these are all the two things which will underpin inflation over the possibly next few years, actually. That is why you are going to see inevitable second wave of inflation, which may or may not hit the previous peak. But you are not going to see 2% inflation for sure. Whatever the target range for the central banks, let's say 4 to 6% as far as the RBI is concerned, that is going to be the floor. That is not going to be achieved, but it is going to be the floor. And similarly, 2% inflation, it is not going to be achieved. It is the floor. So basically, it is going to operate above the floor. That means when the inflation is going to be like this, naturally, you are not going to see lower rates. So structurally higher inflation and structurally higher rates of interest, they are going to stay. You are not going to see all those negative interest rates and all that stuff anytime for sure in the entire decade. And then unemployment. Actually, we talked briefly about unemployment earlier, actually. Global unemployment. Can you believe, actually, this is a peculiar cycle. Actually, the peculiarity I was talking about the services economy versus manufacturing economy. Boss, manufacturing economy is not doing well. As a corollary, actually, exports are not doing well anywhere, actually, possibly. Let's say Indian export, they are just they're at about merchandise export. They're at about $35 billion actually. They're thereabouts. Now, right now, you just see global unemployment trend. Global unemployment trend, as if actually it's a big global expansion. Actually, if you show the graph to anybody, any conservative economist actually who has been there in the market, actually will say the world is experiencing a big, big expansion. Absolutely not. Basically, everybody is forced to work actually. That's the basic idea. Everybody is forced to work. That is why actually global unemployment trend is going lower. That is why you just see the kind of employment data that is coming out of all the major economies actually. Europe, yes, it is in a recession. Germany is in a recession. France is struggling. But unemployment is at low. You just cannot correlate this. When the unemployment is high, we see it is a recession. It is not the case anymore. That is where actually DM-EM problem is there. DM is having that is DM unemployment is going lower. EM unemployment is going higher. Actually, that is what is reflected across the world. Actually, even reflected across India also. So, of course, the artificial intelligence type. Of course, everybody talked about the SAM rule actually. Basically, SAM rule actually that is that is 50 basis points increase in the unemployment rate from its so low from the past year. It will immediately trigger a recession. This is the old rule actually. When the labor force was shrinking, and now you just see the first labor force has been increasing actually, basically because of the immigration. Immigration, that is of course, we'll talk about the immigration later. How do I find out whether the US economy is in a recession or not? Whenever you see weekly claims going past 300 or 350, you have to be careful. Possibly they are touching the recession. Forget about these 2-3 weeks, actually, maybe next week also, because of the hurricane impact. Otherwise, 200 to 250 weekly claims, fair enough, actually. That is obvious. That is normal, actually. Whenever it touches possibly 300 or 350, you have to be very, very careful that there could be a recession. That is one coincident indicator that can tell you recession in advance. And then, of course, I just keeping this slide. This is one data point actually. Of course, these are all things that nobody watches, but actually, if you are academically inclined and possibly you want to predict recession much ahead of others, worker adjustment and retraining notification notice. Actually, one. This notice tells you what is going to be the weekly jobless claims. See, one factor is leading 2 months before the weekly claims. So as of now, you just see July 24, actually October 24 also. The one factor doesn't tell you that actually the weekly claims are going to be higher. So basically, we are going to have the higher employment for sure. And then FOMC, they are bothered about downside to the employment. Higher unemployment, they are bothered. When lower unemployment, they are not bothered. That is what actually all the FOMCs discuss actually. So basically, whenever there is a higher unemployment, actually they all are bothered. Whenever it is a lower unemployment, nobody is bothered. Actually, that of course obvious. And then of course we will come to this equity market sector. It is a roaring 20s. As far as the US is concerned, I can say with certainty that it is a roaring 20 actually. 20 to 29, you just see how it went up. Similarly, it is 2020 to 2030. US equity markets are going to rock. Rock in the sense, actually, it is going to go from one high to another high, and possibly it will continue to register highs, actually. Maybe, actually. Nobody possibly, it is a conviction arising out of actually basically the expanding economy, and the consumer is very strong, and fiscal impulse is very strong, and then money is actually basically the financial conditions are loose. So that is why, and then artificial intelligence, and then technology. Whatever said and done, actually, howsoever you hate US, this is a technology capital of the world. You just see the kind of technology difference between Europe and US, actually. That will tell you, actually. What are all the companies in US and what are all the companies in Europe, actually? Each company technology company in US has engulfed our life. has engulfed our life, actually. That is the dominance of US technology companies. That is why I feel actually possibly US equities actually it's going to have another roaring decade like this. Maybe I could be wrong. Okay, fair enough. But this is the call actually. And then globalization of equity markets. That's one thing actually. It is not that actually Europe is not doing well, but Europe equity markets are doing well. That's the thing. Even if US is not doing well, US equity markets are doing well. Basically because most of the revenue comes from outside actually. You just see 41% of the revenues, total America's largest public companies generate 41% of revenues outside of the US actually. So they are generating revenues to the extent of 41% actually. And then you just talk about the rest of the actually Germany, Austria, Spain, Finland, and all the European countries. They're two-thirds of revenues from outside the national borders, actually. But there are countries which have the domestic revenues, that is especially China. That is why they are suffering, actually. The guys who are getting revenues from outside, possibly they are doing well. So these equity markets who are getting, possibly they have hedged their bets. Actually, if the domestic does well, they will get the revenues from domestic. If the external sector does well, they will get the revenues from there. That is where actually US companies have a edge over others, actually. So volatility, of course, as far as equity markets are concerned, as far as this year is concerned, actually, when a strong start, naturally it ends in a strong finish. That is the historically. So basically, whatever that happens in the November election, actually the markets are going to finish on a strong note, go into the December. If you go by the history, actually, then nearly 74% of the occasions, actually, the first half when it was very strong, 15.3%. The second half normally gives you around 10% return. That is what actually possibly S&P is discounting right now. And then we just see actually basically the consumer. Actually, we were talking about the US consumer. Actually, I was talking about the US consumer. The kind of median market value of household stock market investments in S&P 500. This is a wealth effect actually. The kind of money that they have put in the markets and actually the kind of prosperity that they are enjoying. Current market value is shooting up. That means that the net worth is higher. When the net worth is higher, naturally you go and spend. That is what is happening with the Indian upper middle class, who are directly into the equity markets. So basically, that is why the consumption happens. The upper middle class consumption in India, almost equivalent to the household stock market investments versus S&P 500. Actually, it has been going higher, actually. So at the end of it, actually, as I said earlier, actually, basically the global growth, it revolves around what is happening in the US. Yes, fair enough. Similarly, what is happening in the global equity markets, it revolves around what is happening in the US equity markets. It is 50%. Actually, you need not have to be apologetic about it. Actually, boss, it is the US that is going to lead the world, and the US equity market that is going to lead the world market, basically because it is 50% of the world equity market cap. And then another one is the productivity, actually. Basically, of course, running short of time, actually, productivity. US is having more productivity than Europe, and than Japan, than China, and than the rest of the world. That is why, actually, this productivity differential with the rest of the world is very, very high. Basically because of the technological supremacy that we talked about, and then AI, the way in which they are leading in that is why the war on AI, actually, that is what is being that is happening between US and China. Basically, it is capturing the next decade. Capturing the next decade or possibly in the next decade after next, actually, the artificial intelligence. So the productivity is going to increase dramatically, actually. If the productivity is going to increase dramatically, actually, possibly, you may not say, actually, the US could be very well grow at about 4% a year over the next, possibly into this decade, actually. And then, of course, I have talked about the US so far, actually, basically, since that is why, actually, we will come to the dollar, actually. Basically, you have higher growth, higher fiscal impulse, and higher productivity. That is why actually possibly even if the inflation is going to be higher, the dollar is going to be stronger. You just see since 2010, total return on S&P 500 has been 590%. 150% has been delivered by MSCI Europe and 120% FTSE 100. That is where Europe is there, that is where UK is there. So, US manufacturing economy, basically because of the acts, all these acts actually, basically it is getting an impulse. And then US manufacturing economy is improving. And then government debt actually basically as far as US is concerned, government debt is going up and Eurozone actually fiscal shrinkage is there. So that is why actually ECB has been able to cut the rates, whereas US cannot cut the rates anymore. So that is why possibly the dollar continues to be stronger. Forget about the people writing about debt and all, US debt going haywire and all that stuff. Because it's a reserve currency and there is no alternative to that. You guys can talk about any other combination of alternatives, but nothing is going to come even very close to it. In our lifetime, we are not going to see any alternative to dollar, actually. Come what may, actually, these guys are going to borrow and then they are pumping up the economy and then possibly whoever comes next, actually, they are going to continue with the same fiscal impulse. So, consumer, yes, consumer is very strong. US savings rate as a percentage of net disposable income, you just see this graph. So, basically, US consumer is very strong. That is why retail sales yesterday came very strong, actually. And then, of course, corporate actually. So basically, households are strong. Yes, the household savings are strong. Fair enough. And then corporate balance sheets are very strong. $7.9 trillion in liquid assets. That's why you are not going to see a repeat of 2008 crisis. For almost every $1 liquid asset, actually, basically every $1 upcoming short-term liabilities, they have got $1 liquid assets. To that extent, actually, corporate balance sheets are very strong. That is why corporates are printing higher earnings, actually. And then this is one graph that you can think of actually, basically BEA publishes this graph. And then whenever this line comes below this zero line, possibly it just warns you of the recession. Now, right now, this is a blue line that is here actually. So it doesn't tell you that the recession is going to happen anytime soon, basically because after-tax corporates profits at about 11%, exceed recessionary 2% average. So naturally, the US is not going to get into a recession anytime soon, actually. That is the biggest strength for the dollar, actually. And then, of course, immigration. We all know how the immigration is happening, how the labor force is expanding. That is why when the labor force is expanding big, naturally you just, there are distortions in the unemployment rate. And even Fed reads it wrongly, actually. So you need not have to be worried. Basically, employment is going to be strong across DM in this entire cycle. And then, of course, we will talk about the election risk of 5th November, actually. Of course, it's a toss of the coin anyway. Anything can happen. Anybody comes, actually, there is not going to be any big change as far as the fiscal is concerned, actually. Basically, the thing is, actually, fiscal issuances, they are going to continue, and then dollar yields continuing to go higher, and the growth is going to be there. And then when of course, and then as far as ECB is concerned, and elections, actually, it has a big impact on Europe, actually. If Trump gets elected, actually, boss, you have to sell euro. There is no other choice, actually. As simple as this. If that's a basic thing, actually. This is a Trump trade, actually, basically. Because if the Trump gets elected, Europe will be facing this Ukraine crisis all alone, actually. That's a risk of Europe facing, maybe. If Trump changes mind, actually, that is a different thing. But of course, if at all he wins, actually, then there is a risk, actually. Basically, a risk of euro going down big time, actually. Even now, actually, euro doesn't have any strength to go up, actually. I can bet my shirt on it, actually. Even now, actually, basically, because of the triangulation risk, that is why, actually, a macro guy is more convinced about euro short term than the euro short rather than a technical guy, actually. So, of course, the rise of Southern Europe. Of course, we talked about it. Southern Europe is doing very well, basically because of the leisure economy, experience economy. And then manufacturing economy, the top two guys, actually, they are not doing well. And then UK, boss, come 30th October, you are going to have a big blowout as far as the UK is concerned. Be careful about it. There are actually, markets are taking it very easily, and then they think actually she will put the budget in a very disciplined way, but there is a very big chance of September 2022 repeating actually. So basically, when the markets are actually bullish on sterling, maybe taking a downside put, buying a put, sterling put, actually it's not going to cost much actually, basically into the budget. Possibly, actually, if you get it's just like a lottery ticket, and possibly you will get it actually. Sterling is inherently weak, structurally weak actually. And then, of course, I have got all this thing. As far as China is concerned, at any point in time, anybody talks about China, actually, you remember they have to recover from property crisis, which is not possible in the near future. Come what may, come the fiscal stimulus. And then another problem is it is almost like India, actually. Lack of social safety net. When there is no, actually, you don't have any social safety net. I don't have any social safety net. That is, I don't have pension, you don't have pension. What do you do? Every time we are worried about what is going to happen after my retirement. That is what actually Chinese are facing, actually. That is why the savings in China is going up, 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 up. Whenever actually, basically, what happens to me, actually, I won't spend, I will start saving. So basically, lack of social safety net. So addressing a problem, actually, if you bring a social safety net, possibly people will start spending, actually. That's the basic idea. And then unprecedented demographic crisis. These three, actually, whatever you do by cutting the rates, doing fiscal and all that stuff, you are not going to see China coming up dramatically. Of course, Japan. Of course, all of you know how what my view on Japan is. Actually, it's once again going back to 160s for sure. Actually, so sustaining the way, just like what we talked about China. China is the new Japan. Actually, as simple as this, because you are going to see a China struggling for another 20 years. God forbid. And then China, actually, the same thing. Actually, the wage increases have to happen. Sustaining the wage increase, actually, 3 points. Sustaining the wage increases, ensuring that increase in costs are reflected in the price and goods, and investing to improve productivity. All three are not going to happen. Sustaining wage increase, actually, wage increase will happen, but prices will go up, but these guys are not going to raise the interest rates. And then come what may, actually, maybe October 27 election, it could be another big shocker. So basically, I think we get back to once again to 160 as far as dollar is concerned. And then coming back to our India, actually, it's a K-shaped recovery, actually. As far as India is concerned, actually, whatever you say, maybe actually we will have difference of opinion, definitely for sure. Naturally, as long as you are not betting on my money and I am not betting on your money, actually we can have independent views. The K-shaped recovery. That is why the upper middle class is doing well, and then lower middle class and then lower class actually not doing very well. The growth shifting to lower gear, at least now, actually. Possibly, actually, we are shifting to a lower gear right now. It's not actually, basically, it is not collapsing, but actually, at least in this quarter, quarter two fiscal and quarter three fiscal, actually, we are shifting to a lower gear. Actually, nobody will even think of talking like this. Services at a moderate pace, manufacturing stays sluggish, manufacturing and exports continue to stay sluggish. Basically, we reflect global trends. Let it be with that. As long as global services do well, our services exports also will do well. So as long as that does well, actually you are able to finance your current account. So basically, my worry is my worry is actually possibly this slowdown may not be a transient one. Actually, possibly it will, maybe actually you went up so dramatically and possibly you are going to plateau there for some time. And I think some of the high frequency indicators that I have written actually. So, This is not the view actually, but this is possibly what is the high frequency indicator they are telling actually. This is some sort of a, and at the same time you are having the inflation actually. You are having the inflation. So basically a slowing growth and higher inflation, and RBI continuing to hold the rate steady. And at no point of time we are going to cut the rates. That will be very much sure. So this is the broad picture where actually US is going to stay exceptionally strong. Europe is going to stay weak and possibly fragile, and Southern Europe is saving them right now. UK, you have a big event risk coming on 30th October. And then, okay, fair enough. If they cross the 30th October also, the structural problem continues to stay. The political euphoria is waning. So structural problem continues to stay. So basically, I think maybe a sterling sell-off could happen. Basically, because they are going to have a low growth, some sort of a high inflation setup. And then you have China, actually, unless they, actually, we talked about the 3 points, actually, unless they address property crisis, and then social safety nets, and then the demography. You just can't do anything about the demography right now. Actually, you are basically now you have to endure that. That is why actually possibly Japan is in the Japan has been already made. Today, after announcing the stock buyback scheme and all, actually Japanification is complete. And then Japan, actually, you had that 3 things, actually, wage increases to be sustained, increase in productivity, and then the cost of the prices going up. All 3 conditions they are not going to satisfy. And then politically, you are going to have a tough time post October 27. So you have as far as the dollar is concerned, actually, dollar continues to stay strong. And then whatever the dips in dollar end to be bought, that's one thing. And then you have dollar rupee right now. Okay, let's set the better. I think we are following a different exchange rate policy. Let it be actually, now everybody knows actually, basically, nothing is going to happen here actually. Basically, reserve accumulation seems to be the only motto, actually, fair enough. And then we are going to actually, basically, we are going to go in step with the carry. And then we have given up the benefits of flexible exchange rate regime. Actually, that is what I wrote recently. Flexible exchange rate regime, actually, basically, because when the euphoria strikes the economy, naturally, you have to be very careful. That is what they are. They are careful about what they are doing. So you don't expect any big moves as far as dollar is concerned. Definitely not on the downside, definitely not on the upside. So slow grind. Actually, it's going to be tough task. And the rates, possibly, I think it will stay there and elevated levels for a long time. And then inevitable second wave of inflation is the what key takeaway that I will want you to have as a risk going forward. I think with that, I think I will finish and then possibly take some questions, and then we will wind up. Over to.
Yes, sir. So, yeah, the floor is open for questions. Meanwhile, what I'll do is I'll just try to, I've jotted down a few points as to on what Thiagu sir has taken this session today. He started with global growth trends, talking on inflation dynamics and monetary policy shifts is what he elaborated on. He also discussed about the geopolitical and economic uncertainties that we are into, China's economic transition, energy and commodity markets, energy prices, how it has impacted the financial markets. He has also talked on the currency and exchange rate movements, emerging markets and debt challenges, digital and technological transformations is what he has talked on. I do have a question, sir. What could be the strategic considerations for businesses, as in what is the path forward for businesses here in India? As you rightly mentioned that exports has, manufacturing and exports has reduced. So for those businesses who are into manufacturing and exports, what could be the strategic considerations according to you?
See, basically, across the world, the manufacturing is suffering, actually. Let us be very clear about it. Basically, what has happened in this generation, actually? What do you actually basically, earlier, actually, the consumer used to buy durables, actually. Correct? When the consumer buys durables, actually, basically, the manufacturing does well. Now, consumer has gone into experiences. And then leisure economy experiences, actually, basically, in the normal parlance, I will say, instead of buying a fridge, I go for a vacation to Goa.
Right.
What happened? The fridge manufacturer suffers. That is what is happening. That is why, actually, you have to watch the global manufacturing trend, actually. That is where, actually, basically, the one key issue, actually, I think, I'm not sure whether I conveyed it correctly. That is the manufacturing economies across the world. They are all struggling, actually. China, actually, where actually possibly 20% GDP manufacturing, actually. Germany, struggle, actually. 16%. 15.5% South Korea, actually. That is also actually basically, it is sailing along basically because of the semiconductors.
Correct.
Otherwise, actually, it is very tough, actually. So basically, the manufacturing industry, manufacturing economy is actually, it's under pressure, actually, right now.
Right.
You have to endure, and actually, basically, at the end of it, what is the advice that we can give? You have to endure this cycle. See, every cycle has a terminal point, actually. At some point of time, the guys are going to give up on the leisure economy and experience economy and then come shift to that consumption happening in the manufacturing, consumption happening in the durable sector. See, basically, at the end of it, when the consumption starts happening in the durables, naturally, the manufacturing economy will do well, actually, as simple as this. So till that time, actually, you are going to struggle with the $35 billion exports. Actually, just see, actually, you ask somebody to plot the Indian exports. Actually, it has been there at that thereabouts for a long, long time. Services exports are doing very well, basically because global services are doing well. That's why our services are doing well, thankfully.
Right.
Otherwise, actually, if our services exports have not done well, actually, you would have been in a very, very difficult spot. So you want to endure that. There is no other choice, actually. But the only thing is actually with the endurance through cost cutting and possibly optimization of cost, and then possibly the better exchange rate strategies. That is where actually possibly you make money, actually. Right now, that is where, and then don't, the recency bias that we have to give it up, actually. Basically, what happened in the last decade, it will happen in this decade. I think that should not be the
Correct.
base case.
Right, sir.
Anyway.
There's one more question from Bhuvana Nidhi. Do you think Middle East war will affect us really bad?
Actually, I had some 3 slides, actually, Middle East war and this thing. Of course, paucity of time, we didn't go through that. Actually, the only thing is actually this is going to pull on, just like the Ukraine-Russia war. Actually, basically, it has been happening since, let us say, March 2022. This thing, actually, I think it is going to be pulling on for a long time. Maybe, actually, of course, not wrong in discussing some hypothetical scenario where actually Israel could attack Iran, and then possibly that will send a big signal to oil markets. And then the way in which way in which the financial markets will take the cue from the oil markets and possibly react, actually. My feeling is actually it is going to be some sort of a lingering concern for some more time. Actually, I don't think nobody is going to pull the trigger, actually, especially before the elections, actually. Elections is going to be a big binary risk, actually. US elections, I'm talking. US elections is going to be a binary risk, actually. Whoever wins, actually, possibly, maybe, actually, most of the things will not change, actually. Honestly speaking, going into the election, the volatility will jump. Maybe into the elections, actually, possibly the volatility will be higher. Once the elections get over, actually, possibly the volatility will reduce, actually. So into the elections, you go with possibly, this is what history says actually. So only thing is actually whoever wins, actually dollar yields are going to go higher and dollar is going to stay stronger. That is for sure, actually. What is the time when RBI will reduce the repo rate? Somebody has asked, sorry, I have taken that question.
Yes, sir.
Honestly speaking, I don't see rates reducing in India in the immediate future. Let us say, actually, basically at the end of it, reduction of rates, actually, it is not going to happen. It is not going to help in any way. Yeah. You just think of a situation. Japan has been toying with the negative rates for a decade. What happened? The credit growth did not pick up. Nothing happened. Now you cut the rates anytime. Actually, it is not going to this economy. Actually, this global economy, whether you cut the rates or hike the rates, it's immune. Now, just what is happening in Europe, you just see. He is cutting for the third time. What is the use? Nothing. The recession is, nothing is going to happen actually. Basically, the economic response to the monetary policy cycles, it is very, very fickle right now. Very, very feeble, rather. Very, very feeble. That is why Fed raises rates from 0 to 5.5%, nothing happens. The guy cuts 3 times, nothing happened. China cuts rates, nothing happened. And Japan raises rates by 15 basis points, immediately carry trade unwind happens. That's all. Nothing happened. Otherwise, nothing happened. So basically, cutting the rate, it is not going to anyway help the economy. Anyway, you are in an expansion. Anyway, the economy is in expansion. And the inflationary pressure is very much there, actually. You just cannot brush it aside. And then you just cannot afford to cut when the entire, actually, honestly speaking, actually, monetary policy is dovetailed to Fed. All the emerging markets are monetary policy. Actually, you may very well say, oh, boss, I am independent of anybody. Okay, fair enough. At every part, practically speaking, your monetary policy is dovetailed to Fed. Not actually, maybe not with a specific reference to India. All the EMs for that matter follow Fed. All the DMs follow Fed. Even ECB will not continue to cut the rates like this if US is going to stay expanding. Actually, US is going to be having, let's say, a second wave of inflation or something like that. Nobody can afford, actually. So basically, and by cutting the rates, what is going to happen in India? Nothing. Bank Nifty will go up by another 1%, actually. I think more than that. I guess what will happen?
So there's one more question from Lata Krishnan. What is your take on the US yield curve with growth staying strong in the US? Do you still expect the inverted yield curve to continue?
You actually growth being very strong in US?
Do you still expect the inverted yield curve to continue? Basically, what is your take on the US yield curve at the current?
US yields?
Yeah.
My view is actually it is going to be 3.5, 4.5 kind of a range actually. Maybe actually any dip to be actually basically maybe 380, 420 in the 10 year actually. Possibly I think it is going to stay contained because of the kind of issuances that you have. You just cannot, basically the kind of issuances, the kind of fiscal deficit that you are running, and then if there is going to be a divided house, and then a president from a different party, and then Senate is Republicans, and president of being a Democrat, and all that stuff, and then fiscal deficit is going to balloon actually. They can afford to run a fiscal deficit. Basically, don't compare rest of the EMs and rest of the DMs with US. US is a differently separate this thing. Basically, at the end of it, the safe haven, number one, number two, actually reserve currency, number two, actually basically at the end of it, where all our savings go, actually, basically, let us put it, $700 billion of our reserves, maybe around $500 billion of reserves are deployed in US treasury securities.
Securities, correct.
But for US borrowing, where that would have gone? Basically, US affords, the US gives you a chance. It is just like you investing in a AAA paper, as simple as this. A AAA paper, if you are having money and then you are searching a AAA paper, actually. Something like that. So, US is going to stay strong, and the issuances, that is the worry actually. And then the inflation, and then I talked about the unemployment being in a structurally downtrend as far as the DM is concerned. Actually, you are going to see that 3.5, 4.5. There is not going to be a big unemployment swing in US actually as the previous cycle. And then there is going to be inflation, wage inflation. It's going to underpin wage inflation, shelter inflation. Rents are going to be higher. Services inflation, that is going to be higher. If that be the case, actually inflation is going to stay higher, and then issuances are going to be higher. Unemployment is going to be lower. How the Fed will cut the rates? And then you have historic highs in equity markets. And why should we cut the rates? So that is why actually I feel actually in the near term it is going to be 380, 420 kind of a range as far as 10-year is concerned. At every point of time, at some point of time, actually the higher lows actually. From 360 it moved to 380, 380 it will move to 4. And possibly you will get used to 4, 4.5, 5 kind of a market actually.
Sir, may I ask a question?
Yeah, please go ahead, sir.
So, sir, how will then inflation trends will be for India? And you spoken in length about how things will be inflation would be service inflation will be there in US. So, how will what will be the granular details for inflation in India? Because here I think so the vegetable led inflation and other things are getting more there are more ad hoc movement because of the vagaries of monsoons and all. So how should one take into that? And as you mentioned that even the interest rate cycle here also will remain in the upward trajectory. So if you could just elaborate on the same.
See, basically, forget about this vegetable inflation and all that stuff. Actually, we can go hide behind vegetable inflation to shield the real view. Basically, at the end of it, the global inflation, as simple as this. Actually, forget about our vegetable. It is not that the cost of tomato in US is equal to the cost of tomato in India. Actually, it is not the case. But only thing is, forget about the vegetable inflation. It's a short-term phenomena. Actually, maybe okay, fair enough. Okay, we can live with it, or that is okay. Global inflation, when it is sweeping, actually, you tell me. Actually, basically, if that be the case, when the inflation was not there, why RBI governor chose to raise the rate by 50 basis points on the first day of May 2022? When the Fed started raising the rates, and then the Fed did not relent and then continued to raise the rate. At the time also, inflation was not a printing big time as far as India is concerned, actually. So basically, inflation is only one part of the story as far as Indian monetary policy is concerned. You have got to accept the reality that we are living in a globalized world, whether you like it or not. You just cannot afford to cut the rates when somebody is hiking the rates and when the entire world is facing inflation. Actually, the inflation will reach your shores. Some way or other, it will reach your shores. There is no doubt about it. You just think of the asset price inflation in India, actually. Maybe, of course, some time back, I wrote about Japanese experience about inflation, actually. You just cannot dismiss inflation as some sort of a temporary phenomena which is tied to tomatoes and potatoes. This is a global phenomena. It will sweep your shores. Actually, if it happens everywhere, it will happen here also. You just cannot escape. Actually, a pandemic here. You just think of a pandemic. A pandemic started somewhere in China. It went around the world and then it hit you also.
Yes. So the trajectory is going to be higher. That is what the sum and substance is.
That is
what you are
actually inevitability of a second wave of inflation. It is quite possible. That's the one thing. And then inflation is not the only criteria for the monetary policy as far as emerging markets are concerned. Emerging market monetary policy has to respect what US does, whether you like it or not. And then if you are going on a different path, what happened in Japan and what happened in China, it will happen to you also. As simple as this. If your monetary policy cycle is going to be different from the rest of the world or rest of the US for that matter, then naturally you are going to put the currency on the ropes. So basically, forget about our tomatoes, our potatoes. Actually, I think it is a very, very too simplistic way of defining inflation. My take is macros in picture. Possibly, what will eat us actually? From where you will see inflation? Maybe 5 years earlier, actually, people are asking how inflation can happen in this world. Wind back to 2018 or 2019, people are asking, "Arey, how it can happen?" It cannot happen. 10% inflation in US. Hey, absolutely, you are joking. It happened 2022. So anything, actually, basically, at the end of it, the inflation, as you say, the inflation is a monetary phenomena. Inflation is a global phenomena. You just cannot escape it. Actually, it is there in the history books.
So, as you mentioned, a small point, and I joined. As you mentioned that whenever this rate cut happens, when the US Fed cuts again, it will be for the expansion of the economy rather than a recession coming in.
Right.
And similar should be the case for us also in that case. So that will be just the adjustment that will happen according to whatever step.
Basically, see, at the end of it, we all know actually US has raised the rate by 550 basis points. Actually, at the end of it, actually, absolute level. And then from there, he's chopping off 50 basis points, maybe because of some reason, actually, extraneous reason or whatever it is. And my view is actually there is going to be a pause in November, the way in which data is coming. And it is not that he is cutting it for expansion. Actually, these guys actually saw unemployment and immediately jumped. Was 1 month of unemployment print, immediately he just jumped. Actually, structural trend, you just see, okay, come October unemployment, it could be distorted by hurricanes. Yes, fair enough. They don't have any data before that. And then hurricane data, actually distorted data will be there. November FOMC, what they will take. What is the big information that they have got? Nothing. Retail sales is very strong. Consumer is doing very well. Equity markets are hitting all-time highs. Private sector investment is growing at a faster pace. What more you want? Just sit and relax, yeah. What is the problem? And why India should respond, actually? Because that guy had done 550 basis points, yeah. What we have done? We have done nothing. What we have done? Post-pandemic to wherever we are. We have not done a equal proportion, we have not done. The thing is very, very simple. Monetary policy is not limited only to inflation, growth, unemployment. It is actually emerging market monetary policy is tied to US monetary policy, as simple as this. US monetary policy, despite all this 50 basis point cut and perceived cuts coming in the pipeline, it is continuing to be restrictive. That's the basic idea.
Okay, sir. Thank you.
All right. Any other questions?
Some questions I am seeing. When RBI discusses inflation, they do take into account the food inflation. Do you think it should be? I think I answered actually. I think maybe actually the potatoes and tomatoes actually. I think it can stay in the house and not in the mint state actually. Cutting the rates, by cutting the rates, we use that RBI is not reducing the rate to provide lower cost of borrowing by government. I forget about it, all these things actually. If you remember correctly, actually 2019, 2020 also, they were saying both US is borrowing very heavily. If Fed raises rates, the US will go bankrupt and all that stuff actually. Boss, that is a big book, yeah. It is not like your Chota mota book. Government book is a big book actually. For him, actually raising the rates by 50 basis points or cutting the rate by 50 basis points, it doesn't matter at all actually. You just see actually US $1 trillion a year actually he is paying as interest rates actually. Interest. Ellen is paying interest on $1 trillion. She doesn't mind actually.
All right. So I think there are no further questions. Any questions? All right. I think there are no further questions, sir.
Yeah.
So now as we come to the end of this insightful session, I express my sincere gratitude to Tyagu sir for sharing his valuable knowledge and perspectives with us today, which have undoubtedly enriched our understanding and provided us with practical insights that we can apply in our own strategies going forward. And I'll also want to thank each of you for your active participation and engagement throughout this webinar. There have been no drops in the participants as such. And your questions are also, what make these sessions truly dynamic and enriching. So thank you, everybody. Let's continue to explore, learn, and stay ahead in this ever-evolving financial landscape that we are into. Looking forward to seeing you all in our future sessions as well. Thank you, everybody. Thank you, Thiagu sir. Thank you very much for your
absolutely my pleasure.
Time. And you have a great evening, sir. Thank you. Thank you, everybody.
Yeah. Of course, there is a disclaimer at the opening of the presentation. Actually, basically, all that I discussed, actually, let it remain within the four walls. Actually, thank you very much.
Yes, thank you. Thank you very much, sir.
Of course, if you invest money, it is your decision. It is not my decision, actually.
Absolutely. Absolutely. Thank you. Thank you, sir. Thank you, everybody.